Picture this: a world of renowned companies, cutting-edge technologies, and groundbreaking innovations. The S&P 500 holds the key to unlocking opportunities in the stock market. But is investing in the S&P 500 the right move for you? Today, we're unraveling the prestigious index to help you make an informed choice that could shape your financial future. Welcome back to Investing Insights, where we empower young investors with comprehensive knowledge for their financial journey. In today's video, we're diving into a crucial question: S&P 500, investment goldmine or pitfall? Before we delve into the pros and cons, let's grasp a clear understanding of what the S&P 500 actually is. The S&P 500, short for the Standard & Poor's 500, is an iconic stock market index that represents the performance of the top 500 publicly traded companies in the United States. It's a barometer, a pulse check of the stock market's health. The S&P 500 is an index of 500 U.S. stocks that covers roughly 80% of the available U.S. market capitalization. It is one of the oldest and best-known stock indexes in the world. In the early days, companies like General Electric and IBM dominated the index, symbolizing America's industrial process. The 1980s saw the rise of tech giants like Apple and Microsoft, reflecting the shift towards a technology-driven economy. The dot-com bubble of the late 1990s was a tumultuous period for the S&P 500, with dramatic rises and falls in the index as internet-based companies boomed and bust. A notable moment came in 2008 during the financial crisis, when the S&P 500 plunged, illustrating the deep economic turmoil. Yet it also highlighted the index's resilience as it rebounded in the following years, driven by the recovery of financial institutions and the rise of new tech behemoths such as Facebook and Google. Today, the S&P 500 includes diverse sectors from healthcare to consumer goods, embodying the dynamic nature of the U.S. economy. Its journey from the industrial era to the digital age tells a compelling story of economic evolution and resilience, capturing the essence of American corporate history. Now let's explore the benefits of investing in the S&P 500 for the long term. One major advantage lies in the power of diversification. By investing in an index fund or an exchange-traded fund, ETF, that tracks the S&P 500, you gain exposure to a diverse range of companies across various sectors. This helps spread your risk and minimizes the impact of individual stock performance. Another compelling reason to consider the S&P 500 is its historical track record of delivering solid returns. Over the years, the index has exhibited long-term growth potential, outperforming many other investment options. By staying invested in the S&P 500 over the long haul, you position yourself to capture a share of the growth and prosperity that top companies bring. The S&P 500 index is notoriously difficult for individual investors to beat due to its broad diversification and the professional management behind it. This index comprises 500 of the largest publicly traded companies in the U.S., spanning various sectors, which reduces risk and enhances stability. Professional fund managers use sophisticated analysis and vast resources to balance the index, making it a formidable benchmark. For example, during the 2020 COVID-19 pandemic, while many individual stocks saw extreme volatility, the S&P 500 demonstrated resilience by swiftly recovering and even reaching new highs. This resilience was largely due to its composition of both tech giants like Amazon and healthcare leaders like Johnson & Johnson, which thrived in the pandemic context. Individual investors lacking the same level of diversification and analytical tools often find it challenging to match this balanced performance, making the S&P 500 a tough competitor to outperform consistently. While the S&P 500 offers enticing benefits, it's crucial to consider the potential downsides as well. One notable drawback is market volatility. As with any investment, the S&P 500 experiences fluctuations in value, influenced by various factors such as economic conditions, geopolitical events, and market sentiment. it's essential to have the mental fortitude to weather these ups and downs. Additionally, investing in the S&P 500 means that your success is tied to the overall market's performance. If the market experiences a downturn, your investments may face temporary setbacks. It's essential to understand that investing in the S&P 500 requires a long-term perspective and the ability to stay committed during market downturns. Another significant downside is the index market cap weighting, which means larger companies have a greater influence on the index performance. This can lead to overexposure to a handful of dominant firms, particularly in the tech sector. For instance, companies like Apple, Microsoft, and Amazon represent a substantial portion of the index, making it less diversified than it might appear at first glance. This concentration risk means that if a few large companies underperform, it can disproportionately impact the entire index. Furthermore, the S&P 500 is inherently tied to the fortunes of the U.S. economy. During periods of economic downturns like the 2008 financial crisis or the 2020 COVID-19 pandemic, the index can suffer significant declines, impacting investors who rely heavily on it. The S&P 500's performance is closely linked to the health of the U.S. economy, meaning it may not perform as well during times of economic distress. This connection makes it vulnerable to domestic economic issues that might not affect other global markets. The S&P 500 also does not include small cap or international stocks, limiting exposure to potentially high-growth markets outside the large-cap U.S. landscape. By focusing solely on large-cap U.S. companies, investors miss out on opportunities in emerging markets or smaller companies that might offer higher growth potential. This lack of diversification can be a disadvantage for those looking to build a more varied and potentially lucrative portfolio. Another downside is the lack of control for investors. When investing in the S&P 500, individuals cannot pick or exclude specific companies based on personal preferences or ethical considerations. This lack of flexibility means investors are subject to the performance of all 500 companies in the index, regardless of their individual outlook on particular stocks or sectors. For example, if an investor wants to avoid companies with poor environmental records or those involved in controversial industries, they have no choice but to accept their presence in the index. Lastly, while the index typically delivers strong long-term returns, it may not always match the specific investment goals or risk tolerance of every investor, making it less ideal for those seeking higher returns or willing to take more significant risks. The S&P 500's broad market approach means it is designed to provide moderate growth and stability over time, which might not align with the objectives of more aggressive investors seeking rapid capital appreciation. When investing in the S&P 500 index, several key considerations are essential. Firstly, investors should understand the market volatility associated with the index, as its value can fluctuate significantly due to economic conditions, geopolitical events, and market sentiment. This requires a long-term perspective and the mental fortitude to endure short-term downturns. Secondly, the index's market cap weighting means larger companies heavily influence its performance, leading to potential overexposure to dominant sectors like technology. Diversification outside the index may be necessary to mitigate this concentration risk. Additionally, the S&P 500 is tied to the U.S. economy, making it vulnerable during domestic economic downturns. Investors should consider including international or small-cap stocks to balance this exposure. Finally, the lack of control over individual stock selection means investors must accept all companies in the index, regardless of personal preferences or ethical considerations. Understanding these factors is crucial for aligning the S&P 500 investment with overall financial goals and risk tolerance. In conclusion, the decision to invest in the S&P 500 depends on your individual circumstances, risk tolerance, and long-term investment goals. It offers the potential for significant growth and diversification, but comes with market volatility and overall market dependency. By carefully weighing the pros and cons, you can make an informed decision that aligns with your financial journey. That wraps up our exploration of the S&P 500 and the question of whether you should invest or not. Remember, successful investing requires a solid understanding, thoughtful planning, and a long-term perspective. Subscribe to our channel and join our community as we continue to empower young investors like you on your path to financial success.